Hello, my name is Eddie Tofvik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris milling wheat, Minneapolis wheat, and London UK feed wheat. Paris milling wheat. There had been here one continuing dominant pattern for quite some time here. A quite large pattern that 18 weeks ago took a break on the downside. It is, of course, the dark blue highlighted on my daily chart, late August 24 to late February 25 ascending triangle pattern. This pattern had the requisite combined 5+ touches and is made up from a lot of smaller patterns within it. The main pattern can be clearly seen on my daily chart. 19 weeks ago I laid out targets below for this pattern, and I quote, primary target X would be in the 226 zone with a secondary hard to reach target X1 down in the 194 zone. End of quote. 17 weeks ago the market reached the primary target X, pushing down below it. However, we had a stall in the movement lower during around the 50% absolute Fibonacci line at 219, not surprising. And that level will crop up again later, so please remember it. The reactionary rise we saw back in March only managed to move up to the mauve medium moving average overhead, currently at 217.25, not even testing it, but rejecting further upside pressure. This mauve medium moving average will also show up again, so please remember it. We then dropped lower after that, more or less, down to lows that had not been seen since March last year. In the meantime, I also added a target for the bearish halfway association we made of down in the 206 zone, which I later finessed to the 208 zone. 7 weeks ago, prices reached the target at 208, and 4 weeks ago they reached the target down at 205. This just left the tertiary and much harder to reach target X3 down at 194 still open. I am usually loath to downgrade or retire patterns or targets. I suppose this is my naturally conservative nature, but 3 weeks ago I retired the ultimate and far harder to reach target down at 194. That was after I saw prices recover back up for a second time towards the previously mentioned 50% absolute Fibonacci line, and more importantly up to the previously mentioned declining mauve medium moving average. We have since pulled back down again below the congestion at 208 and down to the newly redrawn since May bright red uptrend, currently at 204, where we seem for now to have stabilized at least. Or started to stabilize, I should say. In the process, we have filled in the big old changeover gap seen in mid-May between 205.5 and 211.25, but on the way down we left a smaller, higher up gap between 214.25 to 214.75. All this has allowed me today to draw a new mid-March to mid-May bearish shift pitch hook, which seems to be able to fit the market's actions. Right now we are just around the unhighlighted middle time, currently at 207. And I'd watch this bearish shift pitch fork, especially the middle time, as we seem to be running out of time. You see, what I mean is that the middle time crosses down through the bright red uptrend in about 4 weeks at the end of July. And I suspect before then something will have to give. Add to this the pressure from above, from the mauve medium moving average and the static 50% absolute Fibonacci line, and it may be that we see a test down towards the July 2021 low at 197.25. Watch this space. Minneapolis wheat. The sideways triangle over February to May had run this market lower in mid-May, but then we saw the impact of the slightly realigned September 19 to date uptrend, currently at 574.25, as well as the congestion below at 578.75, and prices turned higher, with a changeover gap higher, resting for a bit just over the medium and long moving averages, which are currently 617 to 617.5 respectively, and creating a small bullish halfway hesitation that 4 weeks ago reached its target on the top side. In the process, the market pushed up over the April 2024 low at 635 and had been eyeing the overhead August 2018 high at 650 and more at 652, but getting capped by the lesser Fibonacci line at 644, and that was until mid-June when the market made a splendid bullish opening long white Mariposa, peaking over the earlier 2025 high at 659.5, though not by much. However, further up we have more congestion from the November 2017 high at 667, the 50% Fibonacci line of the May to August 24 move at 669, and the May 2021 low at 676, and most importantly, from the July 23 to May 24 dark blue downtrend extension, currently at 656, that capped prices 2 weeks ago and again yesterday. Interestingly, the drop in between those two peaks was only as far as the congestion of the short medium moving average, currently 619, the medium moving average, currently 617, and the long moving average, currently at 617.5. These three had a pair of golden crosses last week, well, almost golden crosses, and arguably a possible bow tie formation of the three moving average. However, it is a scrappy bow tie formation, the medium moving average and the golden moving average, still the gold long moving average, still not crossing over properly, even now, though it is awfully close. I would keep and will keep an eye on that one. Anyway, the recovery this week ended in an indecisive spinning top yesterday, capped by the dark blue downtrend. Not the most encouraging sign for the bulls out there. So where does that leave us? Well, we still seem to have good and slowly rising support below from the three major moving averages. But the final feature is one I spoke about 2 weeks ago, and it's still there just about. It's to look at the action again over June as a possible bullish halfway hesitation. In this, we have a question as to where to measure it from. Should it be from the dip in late May at the 608 level, giving us potential up to where we've already reached, or should it be from the May low, in which case we have potential up as far as maybe 685 area, which is well over the previously mentioned resistances. This continues to be the question for the weeks ahead. Will the market have the incentive to try that far higher or not? London UK feed wheat. There continues to be, still here on this daily chart, even now, these many months, very close now to 1 year even, only one major significant pattern here. A pattern that we have not seen in the other grain markets, and that is the bright red late May to early July 24 bearish shift pitchfork. The market in late February this year reasserted the dominance of this pattern, with prices breaching, then repairing an attempted break higher, over the bright red upper time, currently at 170.70, back in late January and early February. Add to this the earlier this year narrow mix overhead of all the moving averages, though they are now separating out, as well as the 50% absolute Fibonacci line at 180.5, and you had, and I suppose still have, an area overhead that, as I have repeatedly said for months and months, that have been brewing up for a significant move, which happened, or should I say started to happen, over late February and into March. On the point of looking out for patterns, I had said 29 weeks ago, so over half a year ago, and ever since, and I quote, "Even now, still looking for that better pattern to appear, and until that shows up, I'll continue utilising the bright red bearish pitchfork," end of quote. So, now my point has been, and still is, that the bright red bearish pitchfork was and is, after all the temptations of other patterns, still the one key pattern I was looking for all of the time. This leads me to my final 4 points, 3 of which was something that I noted in my annual commentary back in January on London feed wheat. Firstly, I saw there the potential for a very large May 23 to date cat's ears pattern. This is a bearish pattern akin to a double top, but it's formed after a big fall, just as the fall we had earlier in 2023, as well as an even longer term second pattern, an August 2022 to date, very large head and shoulders top pattern. That's what it looks like. These two super long-term patterns are still live, and they both rely on one single feature, and that is their common neckline, highlighted in dark blue on my daily chart. That's currently at 167.90. For most of March, prices slid along the top of the support from this pair of necklines, or neckline. However, 9 weeks ago, prices dipped again below the neckline, setting up the opportunity for a recent bearish halfway hesitation. Potential target X down in the 151 zone, at the same time making the lowest lows and low closes since March last year. 2 weeks ago, when I started to suspect that time might be running out for this bearish halfway hesitation pattern, the market produced a strong and dramatic move lower, easily reaching target X and bypassing the April and May 2020 lows at 149.95 and 148.45 respectively, dipping below the March 2020, indeed 2020 low at 145.43. By doing this, the market had spiked lower into a large congestion zone seen back in between 2016 to 2018, between 136 even to 147 and 3/4. This strong move lower also created a weekly key reversal down for 2 weeks ago and set up a monthly key reversal down for June as a whole. This dramatic monthly key reversal down for June, coming as it did after the monthly key reversal down we saw in April, applied a huge amount of longer term bearish pressure, which we saw exhibited last week, with prices dropping down to the important 61.8% absolute Fibonacci line at 137.80 or 137.90, and the longer term March 2016 to date bright green uptrend, which is currently at 136.55, and most importantly just ahead of the bright red lower time, which is currently at 135.10 of that same old bright red late May to early July 2024 bearish shift picture, from which unsurprisingly we had seen a small recovery since. As I said 2 weeks ago, and I quote, I am prepared to soon give any idea of potentials and actual targets below for a break lower. I just want to be certain, which is why I think the bright red bearish shift pitchfork and the congestion zone 147 and 3/4 down to 136 even, dating from 2016 to 2018, are so important. End of quote. Well, we have had a second consecutive, well, almost consecutive, you could call it, close below the combined dark blue neckline above. So here goes. And for this, I think it is best if I switch over to my longer term monthly charts. Thus, we have a primary target X3 for the bearish cat's ears pattern, which will be down in the 127.5 zone, just below the bright red and big old 2005 today uptrend, currently at 131.30. A secondary, harder to reach target X4 would be down in the 112.85 zone, around where the dark blue lower trend line is, currently at 113.75. For the lower trend line for the 2007 to 2022 ascending expanding wedge pattern. For the head and shoulders top, we would have an even lower primary target X5 down in the 64.20 zone, close to where sits, and this is important, close to where sits the oldest uptrend I have on any of my 200 or so charts. It's the 1975 to date, yes, half a century old uptrend, which is currently at 65.90. I am not even going to give you my secondary hard to achieve target for this pattern, as it is below zero. But please bear in mind that these are very longer term targets, stretching possibly over many years. But they are still targets below for these patterns that we've broken above. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.